Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, February 17th, 2023. Great having you with me here today. And today we're going to talk about housing, still an industry in disarray. What did we get? We got housing starts down 27.3% year over year. And that from the last month, at a decline of 4%. So clearly an issue with housing. Single family, not so much, coming in down 8%, but very weak news there. We look at permits. Permits continue to fall on the single family housing side. Yeah, we saw a bump up in interest rates. We're now seeing 6.5, and that has depressed again the purchase interest out in the marketplace. And what's particularly not helping also is completions still seem to be a little slow. We did get a jump, overall 1%, and a single family up 4%, but the amount of under construction fell. So we would hope that maybe this pause, this lack of activity out there would actually start lowering price of new homes. And with that, we could actually start seeing some energy. But in our anecdotal comments, we've seen, some builders doing it, but the other ones are still pretty busy. And so maybe a little bit of a discount for framing a key component. Lumber is down. Maybe that is helpful, but it really hasn't all translated into the marketplace. And so there are seasonal elements. Northeast sort of weak, South continuing to be, better than what we've seen. But with the healthy employment numbers, we're seeing that translate into more car sales, formations from jobs, create car sales. They usually go in tandem with housing, and we should see it here. We're still chronically short. Not surprising as we look for additional data coming in this month. On the previous month, we're probably going to see existing homes for sale fall under 1 million. We're going to continue to see weaker sales there, and maybe a little bit of adjustment in price and a lengthening of the purchase period. But those are really sort of anecdotal, not really connected. We need a supply, we need a vibrant market, we need lots of turnover so that people, as they get jobs, can move in, and that we have the supply. And we're still in a tragic situation where we don't have the raw materials in housing availability that then can push, even though interest rates are higher, that would kind of create a better mechanism. And through that mechanism, we would get prices to ease down a little bit due to the raising of mortgages, and therefore correct in a timely manner. So that's a struggle out there. This is a slow process, and it's going to be a tough one. And as we look towards the spring season, I think there again will be dislocations. Not surprised, we might see a little bit of a spike in price because people will finally say, I'll eat that additional interest rate payment to get finally into something because I've postponed it for a year. So as we struggle through the adjustments in the economy coming out of the pandemic and the accelerant that was put onto the economy through the fiscal stimulus, we are getting a slowing down with higher interest rates, but the dislocations that are out there persist, and that will only cause more trouble in the future. This is Scott Murray for the Daily Economic Market Shout. Thanks for joining us. Excuse me.